Hi everyone, welcome back to the channel. So previously we have done question number 1 to 30 of the investment banking series. So today we will be moving forward with question number 31 to 35, 34, because there are only 34 questions in the accounting basic questions. So after that we will be starting with the advanced level questions. I hope you have watched the previous videos also. If you have done those videos, if you have watched those videos previously built videos, then it will make much more better sense and you will be able to uh, catch up with the pace which we are working on. So without wasting any time further, so let's get started. So question number 31. So the question is asking if even if a company is having a positive EBITDA, earnings before interest, tax, depreciation, and amortization. Some people say it as EBITDA, and some people actually call it as EBITDA, EBIT and DA, EBITDA for the past 10 years. If a company has a positive EBITDA for the past 10 years, but it recently went bankrupt, how could this happen? So, a company in the financial statements, it sounds well and good, but still the company actually went bankrupt. And how did this happen? If you are only analyzing the income statement, not the other two statements. So that's why for an investor, it's very important, or for an analyst, it's very important to assess all three statements altogether. So this could have been, you can catch all these things and proactively work on to that to or you can stop your future losses if you do your due diligence. In financial terms it's called due diligence. So if you have done your homework, then you can save your losses. So So there are several possibilities which an analyst has to look into, or there are several possibilities because of which this can happen, where a company has company had a positive EBITDA, but it went bankrupt. So one first possibility is that the company is spending too much on capital expenditure. So too much on capital expenditure, and these are not reflected at all in the EBITDA, but it could still be cash flow negative. So if you remember previously when we have discussed the Excel part, so if we are investing into PPE, now I'm assuming investment numbers are negative. So if I am assuming $1,000 PPE, so this is going to cause $1,000 outflow, and this will make my cash flow negative. So cash flow would be negative by minus 900. Okay, this debt, I have to remove the previous numbers. So just to see the impact of what the PPE would do. So the PPE, if you are investing in PPE, so it will reduce our cash by negative the amount of which amount the amount by the amount we have invested for the PPE. So it will reduce our cash negatively. It will impact our cash negatively. But this change will not be reflected in the income statement because whatsoever is left after everything, the net income component, that gets linked to the shareholders' equity in the accumulated retained earnings or accumulated deficit portion. So income statement, the this something from income statement is actually linked to the balance sheet, or something is linked to the cash flow statement, but nothing from these two statements is actually linked back to the income statement. That is why the first when we are forecasting or building a model, so first the step one is to build the cash flow statement. The step two will be to build the cash flow statement. And the step three will be the balance sheet. So these will be the three steps in this order. If so, step one, the income statement, the step two, the cash flow statement, and the step three is the balance sheet. And this is important. And when you are asked answering any question related to these statements, so always think in this order: the income statement, then think about the cash flow statement, what would be the impact on the cash flow statement, and think about the balance sheet statement after. The third, the last step should be thinking about the balance sheet, what the balance sheet will have the impact on. So EBITDA, we have discussed the PPE portion. If you are investing in the PPE, then we are going to have a negative cash. The cash is going to reduce, and if we are reducing the cash, then we actually will be reducing our retained earnings also, or the other components here in the liability section, because we actually have to balance our balance sheet. So this is an important question, and this is actually a good question also to test someone's knowledge. Okay, then the second possibility is that the company has a high interest expense and no longer able to afford its debt. So this might be also a possibility. And if we look at the third possibility, that all the company's debt matures on one day and it's unable to refinance it due to credit crunch, and it runs out of cash completely when paying back the debt. So if I look at the balance sheet on the find the Excel, so if I am saying that we actually have a debt of 900,000, let's assume, and everything matures on the same day. We actually had a debt of 900,000 and it is now mature. The debt is matured today, and we actually we raised it earlier, but now from the financing activities, we actually have to pay it back. So I will put a negative sign here. So if I put a negative sign here, so this number is going to be, I mean, way too big. And companies do have a debt structure in the working capital. They have the debt. They actually use debt. And if we are having this much debt, so if we are paying interest, so this interest will be somewhat around 10% of 9,000 will be 900. So we actually have to pay this much interest every year. So this is going to impact our earnings negatively. But it depends on how much is the EBITDA, EBIT. So if the EBIT, we have not plugged in the numbers or EBIT, we have not plugged in the numbers for EBIT. So this is going to reduce our net income. So we cannot show a net income of negative 540. So that doesn't means that means that we are in a loss of 540. A loss of 540, and from somewhere we actually have to cover that loss. So uh, this will impact the other statements also. So the operating expense portion, until here, everything is good, everything is normal. But afterwards, the interest component has increased. If we are the debt matures, because of the debt maturity, we are investing heavily into PPE, so the net income is going to fall down. And after EBITDA, so EBITDA is I mean, it's a important metric, but it's more important to see how much, what is happening after EBITDA, reporting the EBITDA. So what the company, after EBITDA, the true pictures reveal itself. So that's important to learn, and that's important to understand. So one, two, three we have discussed, and the fourth possibility is significant one-time charges, and those are high enough to bankrupt the company. So litigation, if somebody has sued the company, so these kind of things. So one point here it's mentioned that remember EBITDA excludes investment in depreciation of long-term assets, interest and one-time charges, and all these could end up bankrupting the company. We have discussed this portion in the Excel part. All right. So this was a very good question, and I I will recommend you to just pause the video, read the possibilities, and think about it from your perspective, and try to try to digest this thing. Okay, so question number 32. So normally goodwill remains constant on the balance sheet, and why would it be impaired, and what does goodwill impairment means? Okay, so goodwill impairment. Goodwill is impaired, not depreciated or amortized, but goodwill is actually tested for its impairment. So the correct word will be impairment, not depreciation or amortization. So this thing is important. So if what does goodwill means? So if someone is actually acquiring a business and they are overpaying, so the amount they have overpaid will be used as a provision on the balance sheet, and later on they impair goodwill time to time, and they then remove that goodwill portion and run it through the income statement part. So goodwill impairment usually happens when the company has been acquired and the reacquire and the acquirer reassesses the intangible asset and find that they are worth significantly less than they originally thought. So this is one possibility, and it often happens in the acquisition where the buyer overpaid for the seller and can result in a large net loss in the income statement. So if they have paid something and that year if the company is acquiring a business and they have paid a considerable amount, and that year the company is making profit also, so what they will do is they will run the some amount of the goodwill in their income statement, and they will try to pay as less as, I mean, they will try to take a tax benefit on that. So this is an important treatment of goodwill and a use of goodwill. Or it The third possibility is that it also happens when company discontinues a part of its operations and must impair the associated goodwill. Yes, if you have different lines of businesses and some business line is discontinued now, so you will impair the goodwill and run it through the income statement. Okay, so I hope this is clear. Think about it, and whatsoever, if you have doubts, then please post a comment, and I will be happy to answer those questions. Also mention the question number which you are talking about. So let's move to next question. Question number 33. Under what circumstances would goodwill increase? So goodwill increases under two circumstances. So the company gets acquired or bought out, the goodwill changes as a result, and the company acquires the other company and pays more than what its assets are worth. So the goodwill numbers are increased. Then the goodwill numbers increase. So these are the two possibilities. If I am acquiring a company and I am reassessing the goodwill, so that's one case, one possibility. And the other possibility is company gets acquired and somebody pays you more than what the assets were. So in that case, we put those numbers in the goodwill section of the balance sheet. And these are the very rare cases only. If somebody is, I mean, when we will discuss the portion where we are the current value and the market value of the assets, then when we will talk about the current value and the market value of the assets and liabilities, then there are different provisions for that and the government rules. So as per US GAAP and IFRS. So there are different rules, and then it will make much more sense. But as of now, when in journal, without looking at the numbers or without looking at the access, when without looking at the data, so if somebody asks you the goodwill, how the good circumstances and the goodwill increases, so these are the basic circumstances that actually everyone should know. The basic things. These are the basic circumstances which actually increases the goodwill of a company. Okay, so I hope this is clear. Question number 34. Okay, this is a big question where the difference between LIFO and FIFO. And okay, let's talk about this example for a moment, and then we will go to the Excel part. I will take you. I prepared an Excel for this also. So difference between LIFO. LIFO is last in, first out, and FIFO is first in, first out. If I am saying one, two, three, four. So if I'm starting from the end, it's if I'm start the one, two, three, and four. My stylus is not working. So if okay, if there is a sequence of year one, year two, year three, and year four, or something you have bought in a sequence of one, two, and three, four, and you have put it in your inventory. So if you're selling things from the last, so that's called last in, first out. So if you are following the sequence 4, you're selling the product at 4 first, the product at 3 first, and product at 2 first, and product at 1 first, then it's called first last in. So whichever was the last in, the fourth one was last in, so you will sell it first. The third was before 4, so you will sell the fourth part. So that's last in, first out, and FIFO is first in, first out. So if we are selling from the spot one, so that will be first. So whatever came first in, that will be sold first. But that makes sense. Okay, so now think about oil barrel, a big oil barrel. If you are filling it with oil at different times, and you actually have to sell oil. So you will apply first in, first out, or last in, last, first out. Which will you apply? Because it will be practically impossible for you to sell the oil which will be at the bottom. Or think about grains, the way they are stored. So granary, you cannot uh, go deep into the vessel where the grains are placed. So you will actually have to use LIFO there, last in, which whatever came last, you actually have to sell that first. And in FIFO, the first in, first out. So that actually does make better sense. We'll talk about it. So let's discuss the explanation given with the question. The question doesn't apply to you if you outside of US. IFRS does not permit LIFO, last in, first out. IFRS doesn't permit this. And why? We will discuss about it in a moment. LIFO stands for last in, first out, and FIFO stands for first in, first out. There are two different ways of recording the value of inventory and the cost of goods sold. Okay, with LIFO, you use the value of the most recent inventory for COGS, but for FIFO, you use the value of oldest inventory addition for COGS. Okay, so let's go to Excel because reading the explanation without any practical use is of no, I mean, it's very difficult. So practically, if I am saying like year one, year two, let's understand the scenario what I have done here. So these are the years one, two, three, four, and five, six. I am assuming inflation, given there is inflation, inflation is causing prices to rise of inventory. Pardon my uh, grammatical errors. So every year inventory is rising. Here inventory was at 10, year 1. Year 2, the inventory prices have risen because of inflation. Because now at year 3 it's 12, year 4 13, year 5 14, and year 6 16. Okay, so inflation is causing the prices to rise. In units, I have purchased year 1 I have purchased 100, year 2 I have purchased 50, 60 as per the requirement, 70, 90, 80, 90. So total purchases are simply the multiplication of prices and the units, prices and the units, prices and the units. Okay. If I have to sell 300 units today, okay, not 300, let's assume 150 units today. So if I'm using LIFO, LIFO means last in, first out. I will start from down. So LIFO means 150 units. So if I'm using LIFO, so I'm going to use 90. So I am going to use units are 90. Last in, first out. Okay, just give me a moment. So I'm going to last in first out. I'm going to 90 units, but I have to sell 150. So 90 units I have sold these 1350, and I'm still short for 60 units. And the 60 units I will sell from here. I will sell 60 units from here. So that will be my LIFO, cost of goods sold. And here I will be left with 20 units. I hope you have understood this thing. So LIFO, last in, first out. So this came last, so it will be first out. And FIFO will be first in, first out. If I have to sell 150 units, then simply I will actually have to sell this much of inventory will be sold from my end. So LIFO is giving me 2190 and FIFO is giving me 1550. Here the ending inventory will be 0 and I will be left with this much. Give me a moment. The balance as per LIFO should be there. Uh, balance as per FIFO. This is balance as per FIFO and this is balance as per LIFO. So this is balance as per LIFO. This is 0. We have used this. And here we have 70. These units are still there. And these units are here. Okay, if we are discussing this much, let's discuss this also, this part also. So ending inventory as per FIFO and ending inventory as per LIFO. So this will be until here, and out of uh, this is 0. And if we talk about the ending inventory as per LIFO, okay. So if you look at the question now, we have sold 150, and if you remember the sequence of the we have sold 150 units, and price per unit, I if I'm assuming uh, price per unit is 15, I am assuming 16. Current rate is 16. So my revenue will be today at 16, 2400. So if my revenue is 2400 and I am selling two cases, 2190 and 2190 and 1550. 1550. 2440. Let's assume this thing. Rather than here, let's ignore this thing and just understand the question. So if I am selling 2190 worth of goods for 2400, and if I am selling 1500 worth of goods for 2400, if I'm selling this, so after everything, I will show a loss. After everything, I will show a loss. If I'm using LIFO. So this is LIFO and this is FIFO. If I'm using LIFO, I will be showing a loss after everything happens. And if I'm using FIFO, I mean, if I'm using LIFO, there will be less net income. The tax component will also be less. If I'm using FIFO, so I will be paying to the government and the net income will also be high. But one more thing that we need to consider, we need to be, we need to pay attention to is under LIFO, the inventory balance is less, and under FIFO, the inventory balance is high. Under LIFO, the inventory balance is less, and the ending inventory is less under LIFO, and under FIFO, the inventory balance is high because the current prices are used, and because the inflation is causing the prices to rise, so the ending inventory Here, the ending inventory, the ending inventory is less in LIFO and the ending inventory is high in FIFO. So less and high. And this is the main reason why government doesn't allows you to do this. So the US government doesn't permit you. Only IFRS does because IFRS the rules and regulations are a little less strict than US GAAP. But the US GAAP rules and regulation are. I mean IFRS is followed throughout the world. So IFRS doesn't permit the use of LIFO, but US does. That's in some cases. Here, the whole explanation is given. So, in general, the inventory is getting more expensive to purchase. So, LIFO will produce higher value of cost of goods sold and lower ending inventory. So, LIFO will produce higher cost of goods sold. LIFO will produce higher cost of goods sold. The cost of goods sold will be high, and the ending inventory will be less. And FIFO will sell cost of goods sold will be less, but the ending inventory will also be high. So in future, if you want to purchase cheaper goods, so we will, if the prices are still increasing, then we will be selling the cheaper goods and we will be realizing more profit. So LIFO or FIFO, more profitable is FIFO. And that's why IFRS doesn't allow LIFO. FIFO is more profitable. That's why it's considered. That is the reason why LIFO is not permitted by IFRS. Okay, this question was actually a little tricky, and a lot of thinking has to be done. A lot of thinking and processing has to be done to understand the concepts of LIFO and FIFO. So, this is the end of the series where the basic accounting questions were. Now, in the next video, we will be starting with accounting questions and answers, the advanced questions, and there are 15 questions only. So, but the 15 questions are actually tricky questions. They are more trickier than the previous questions. So, all the very best with learning and keep revising because the concepts of accounting are actually very, you actually have to keep on brushing them. If you do not brush them regularly, you will forget. You will actually have a tendency to forget them. There are a lot of change going around the world. So, keep learning and all the very best. Thank you. And if you have learned something of value today, please subscribe to my channel. Thank you, everyone. Thank you.